Welcome to Cut to the Chase. Today is Wednesday, the 26th of November. I'm Daniel Lam, your host for the podcast. Are we there yet? Well, I've been hearing this expression both outside and at work. Outside because that's what my kids kept asking me when we're at a ferry ride over the weekend. At work, that is where many clients care about checking if we believe the markets have bottomed yet. Well, the recent correction is due to the heavy positioning in US equities, where it was at plus 1.75 standard deviation from the mean positioning. We see limited risk of a prolonged correction though, because the US data is not as bad as what people were expecting, and we estimate the risk of hard landing over the next 12 months to be at only 20%. In such circumstances, typically the correction would last for 45 days. That means we are around 1 to 2 weeks away from the market bottom. And that makes sense. After all, the FOMC meeting is going to be on the 10th of December. It is uncertain whether there will be a rate cut, but it is likely that this meeting and the press conference after will clarify many questions in investors' mind. Now, investors do value this clarity factor in 2025. Look at what happened after Liberation Day. At the start of 2025, investors were highly concerned about the uncertainties surrounding the tariffs. After Liberation Day, tariffs became higher versus the start of the year, but so were global equities. In terms of key levels to watch for in S&P 500, we had highlighted the key technical levels in 6,600 and 6,400. Now, looking at the magnitude of such positioning-led pullback and comparing that to the current correction, we see that the S&P 500 is likely to be bottoming very close to the intraday low at 6,522, which we saw back on the 21st of November. And this is very much in between the two technical support levels that we just spoke about. So, what should investors be doing now? Well, they can go and buy the high-quality, large-cap technology stocks if S&P 500 re-enters that 6,400 to 6,600 zone. However, if there were to be no pullback, and if US equities were to correct deeper than these two technical support levels, then what should investors be doing? So therefore, we advocate a barbell approach now with defensive growth ideas on top of US technology stocks. So we like US pharmaceuticals, where earnings are defensive and there's receding regulatory risk, as well as US utilities, where we project a doubling of electricity demand in 2024 to 2034 versus the preceding decade due to AI data center build-out. If we add exposure to such stocks now, then at least you will have some exposure to the upside if there were to be no further pullback this time around in US equities. If there were to be deeper correction, then these stocks will be relatively more defensive. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.